Okay, so welcome to the last session of today. It's a great pleasure to introduce Teemu Pennanen, which I think I butchered the name, but I hope that was close enough. And Teemu's from King's College, and he's going to be telling us about defined benefit liabilities.
Yes, thank you, Mr. Chairman. Thank you, Georgia, other organizers. Very happy to be back in Rio, as always. So I'll be talking about pensions. DB stands for defined benefit liabilities. So financially, that means something like a pricing of contingent claims. Defined benefit is essentially a long-dated stochastic sequence of payments in pensions. And there's lots of uncertainties in the payments as well as in the financial markets, which the pension funds and pension insurers use to hedge these claims. So it's very much a math finance problem. But I guess for some traditional reasons, these problems are often treated very differently from other math finance problems in other sectors of financial markets. And what we're trying to do here is to take this more financial, more economic approach to pensions, risk management, and in particular in the valuation of these pension contracts. It's a topic that I've been working on for many, many years. We had a small spin-off consulting company in Finland. I was working for doing these pensions problems full-time for about 3 years before moving to London in the academia. And I don't think I ever spoke about these things in IMPA, so I thought it's maybe a time for that. So I have a stupid number of slides, but many of these slides are figures, so I'll try to browse through them quickly. So there's also another point, which is what I want to emphasize, and that is something that I talked about before in Rio in other sectors of financial markets. We're going to develop this asset liability management framework now in the context of pensions. So we are going to model a pension fund or a pension insurer. And then all the valuations, like the valuation of defined benefit liabilities, will be based on this ALM model. So it's very close to things like indifference pricing, but not quite. It builds on optimization problem, and then we formulate pricing problems or the valuation problems on top of that. So unlike in the traditional math finance literature, where people often view asset liability management or optimal investment and pricing problems as two different strands of the science, we sort of incorporate them in the same framework. And we also try to connect those things to these actuarial principles of discounting when valuing liabilities. And we do cover those as special cases when we specialize to these naive deterministic market models. On the other hand, if you specialize the approach to complete market models, you will recover the risk-neutral valuations like the Black-Scholes and so on. But in general, we operate in a stochastic framework where both the liabilities, the asset returns are uncertain, and the market is far from being complete. So that's why you need to introduce risk preferences, and you cannot price things by replication. It doesn't make sense here. So just as a way of introduction, here's the classical discounting principle. So we are looking at a problem where you think of a closed fund that has some liabilities, insurance liabilities or pension liabilities in this case, which will run off at some point. When the last member in the pension scheme dies, there's no more pension payments to be made. And we are looking at these kind of questions where, for accounting purposes or for financial statements of the insurer at the end of every year, they have to come up with the value for the liability side. And the question we're asking there is, how much money today would you need in order to pay out those claims in the future? So you will be able to run your insurance company until the runoff of the liabilities. So we'll denote the yearly payments by CT, so that's the aggregate amount of pensions that the insurer is liable to pay in year T. And if you assume that there's now a single investment asset in the financial market and denote the yearly returns on the investments by capital RT, you can write in a deterministic setting, you can write the valuation problem like this. So you're looking for the least amount of initial wealth so that when you invested in financial markets and at the end of every year you pay out the pensions claims, you would end up in a non-negative final wealth. You end up in surplus. So we are looking for the least amount of initial cash that allows you to hedge those claims, just like Black-Scholes did back in the 73. And if you do assume this silly deterministic world, what you end up with is exactly what the actuaries call the best estimate for the value of liabilities. It's this: you simply discount those future payments by the investment returns and you sum them up. So that's completely fine in a deterministic world, but the world is far from deterministic, and in reality the actuarial discounting principle doesn't make much sense. It doesn't have the economic meaning that you have in this problem. So this problem is really modeling what happens in this pension fund, how the money flows and how their investments work. So the discounting formula is fine in a deterministic setting. In stochastic it's not. But this formulation still almost makes sense. When you go to a random world, then you have to relax the super hedging or the replication requirement a bit, because that's just too much to ask. No insurer really believes that they can be fully hedged in every scenario. So you need to model that in a stochastic setting, and that's what we'll do. We start by modeling the asset liability management problem with liabilities, and then you can look at the optimal values of that as functions of the liabilities and determine values like indifference prices and these accounting valuations for liabilities. Here's a list of some relevant references. There's a nice book by Hans Bühlmann from the early 70s where he looked at these kind of questions in a very simple market model setting. In his models, the markets often only have one asset, but the principles are pretty much the same as what we are going to use. There's a large literature on risk measures. If you know the classic paper by Arsenault, Delbon, Eber, and Heath on convex risk measures, they were looking at exactly at the same kind of problem. They also had only single asset in the market, and they, in addition, assumed that to be perfectly liquid. But the motivation was the same. The story they told when they came up with the definition of a risk measure was the same as this valuation problem. There's a more advanced version of that in this paper by Arsenault, Delbon, and Koch-Medona, where they have a more realistic market model and they do the same thing. And then here's a list of papers that I'm going to be sort of summarizing here. So what I'm going to say in the next 40 minutes or so is sort of I'm going to touch on several points in this model development and this numerical solution, just to give a flavor of what kind of work these kind of applications involve in practice. So I have to start with some annotation just to introduce the basic model. Again, CT denotes the aggregate claims that the insurer is liable to pay in year T. Now we are going to look at the multi-asset setting. So there's a finite set capital J of assets traded in the financial markets. I will assume liquid financial markets, so there's no bid-ask spreads or transaction cost, just for simplicity. Everything that I'm going to say would work in a more realistic models, but I stick to this liquid model for simplicity. And I'm going to look at dynamic trading, where the amount of wealth invested in asset J over the Tth year is denoted by H sub Tj. And then we assume the classical filtered probability space, and those strategies have to be adapted to the information. There may be some portfolio constraints. I will denote the feasible adapted strategies by N sub D. N stands for non-anticipative strategies. And here's the alien problem. It's very much simplified problem from the practical side, but it still has many of the same features. It's still a difficult problem, also, although it's very far simplified. And it's very subjective. The problem formulation and its solutions depend on the probabilistic model we have for the uncertain factors, the investment returns and the liabilities. There's some risk preferences described by some kind of a risk measure or a utility function or whatever. It's just some numerical representation of the risk preferences. And that's, of course, highly subjective. Just like the real problem is in practice when you face uncertainties in incomplete markets. So what do you have in the market, in the model? You have the budget constraint here. On the right-hand side, you have the amount of money you collect from the investments you made at the beginning of the previous year. So you sum over all the asset classes, the amount of wealth invested in the asset times the yearly returns on that asset. And when you get to the end of the year, that's the amount of money you collect from your investments, and you use that to pay out the claims for that year, and the remaining amount you reinvest in the financial markets. And you go like that until the end, and then at the terminal date you look at your net wealth, and your optimization criterion is a convex function of that. So think of something like expected utility for the convex function. So that's the problem. So you start with some initial fixed portfolio. So age at time -1 is given. And that's your problem. Like I said, very simple problem, assumes perfect liquidity for the financial markets, but still it has many of the features the real problem has. In particular, it's difficult to solve. You can rarely solve these kind of problems analytically. In some special cases, like the classic Merton problem, you're able to do that, but in general, not. So we will need to use some heuristics and numerics for that. And here's the example that I will be dragging on. We look at the Finnish private sector pension system. It has some couple of million members. And we are going to price or value the pension liabilities there. Or more specifically, we look at old age, disability, and unemployment benefits in the Finnish system. And the claims depend on how people live and die. They also are indexed. The benefits are indexed, so the yearly payments depend on the price and wage inflation. And the biggest source of uncertainty is really the longevity risk or mortality risk here. So that's an essential part of the model. Then on the investment side, we assume in this exercise that there's 5 equity indices and 2 bond portfolios where the insurer invests in. And then we're going to build a stochastic model for that. So that's part of this talk. I'm going to now briefly describe the stochastic model just to give an idea what that involves. Because there's many interesting points in the development of that already. So first, you want it to be simple. It's going to be high-dimensional, roughly 10 to 20 risk factors. We are going to model those as with this kind of first-order linear stochastic differential equation, where in discrete time you get this autoregressive model of the first order. So what we do here, this X stacks up all the risk factors from the liability side and the asset side. At the liability side, you have risk factors describing the longevity developments, the price inflation, wage inflation. Those are all stochastic. Then on the asset side, you have we model bonds through modeling the yield and possibly the underlying index if they are IndexLinked bonds. I'm going to look at that quickly. And equity indices, we do something really simple there, essentially just Brownian motion. Could be more complicated, but that's, I think, what we did in this model. And then you stack all the risk factors up. You may make various data transformations, like instead of the stock indices, you model the logs. Instead of the YTMs on the bonds, you model the logs of the YTMs, or some other nonlinear transformation of the YTM. The aim of those transformations is roughly to come up with a multivariate stochastic process that is in a way close to a Gaussian process that would hopefully fit into this kind of model. The innovations here, I mentioned Gaussian. We did model them as Gaussians. That's not necessary at all. You could use more heavy tail distributions there, and everything would go through just the same. So, quick description of the stochastic mortality model. That's a popular topic nowadays in pensions. There's several proposals for that. It's a fairly recent topic. It became popular since, I think, early 90s. And by now, there are many, many models. Here's sort of a generic model that incorporates many of those. So here, we denote by capital EXT the number of individuals aged X at the beginning of year T. And then it's quite natural to assume that the end of the year size of that population is binomially distributed with some survival probability, P, which depends on the age and the year. We are going to model these probabilities as a stochastic process. So since it depends on the age, it's essentially a curve across all the ages. So very, very high dimensional. In this application, we model ages from 18 to 100-year-olds. So that makes it an 82-dimensional stochastic process. We are going to reduce the dimensionality like this. First of all, since there are probabilities, we take the logistic transformation to map it to the whole real line. Then on the whole real line, we use this kind of a Galerkin approximation. We have some fixed basis functions depending on age, x, and then we assume that the logistic probabilities depend like this on the age. So it's some linear combination where these weights v are parameters that we fit to the data. Those will be the risk factors describing the uncertainties in these survival probabilities. And in this exercise, n will be 3. So we describe the 82-dimensional stochastic process of survival probabilities using only 3 risk factors. But it turns out that it fits pretty well. We use these kind of basis functions. These dotted lines here are our basis functions. The first one is, well, let me show you a picture of data first. So this is historical data of Finnish males. What you have here on this axis is the year. So you see data from going from the beginning of the 20th century up to, I think it goes up to 2006. And here you have the age. So you see that the 18-year-olds where this data begins, the survival probability across a year is almost equal to 1. When you get to the older groups, the survival probability goes down. And then at the 100th-year-olds, it's very wiggly because the Finnish population is small. If you look at the 100-year-olds males in Finland, there's not too many of them. In some years, everybody died in that age group. In some years, everybody survived, so that's why it's so wiggly. If you go to the younger cohorts, they are much bigger cohorts, and that's why you get this smoother behavior. And here is what we did with our model. We used this data and fitted this sort of logistic representation of the survival probabilities with this 3-factor model. And these are the survival probabilities after max likelihood estimation of those parameters. So the idea is that you fix those functions phi, which depend on age. What we did here, we use these 3 functions. The first one is this. It starts at 18 at value 1. It goes to 0 at 50, and then it stays at 0. The second basis function starts from 0, goes up to 1 at age 50, and then it declines to 0 by 100. And the third one is that one. So if you take all linear combinations of these, you will get any piecewise linear function that has a kink at 50. And that's how we model the logistic survival probabilities. And it's easy to fit to data. You do it year by year and optimize those 3 factors, V by max likelihood, with the given data, and you get this. These are the survival probabilities of the 18-year-olds, the survival probabilities of 50-year-olds, and for 100-year-olds. What you see in the figure, if you look, it starts at the beginning of the 20th century. There's a drop here. That was the Finnish Civil War and the Spanish flu. They hit the population at the same time, so a lot of people died then. Then you see the war, Second World War, and then there was a small break, and then the Winter War with Russia, and that's what those peaks are. In the 50-year-olds, they were also affected by the Civil War or the Spanish flu, or maybe both. The 50-year-olds didn't go to the war that much, so they weren't affected too much. And here's the 100-year-olds. And what's noticeable here, they all seem to drift upwards. So that's the longevity developments. People are living longer and longer. In particular here for the 100-year-olds, there's this sharp peak in the recent years. So the old people are getting healthier and healthier. That means that the pension insurers have more and more to pay because their liabilities extend further. So the way we now model the mortality risk, we model these 3 as stochastic processes and then just plug those into this logistic, the survival probability model, and that gives you the stochastic longevity model. So that's that, the quick description of that. And then for bonds, we look at in general inflation-linked bonds or portfolios of bonds. These pension insurers, they often like to classify their investments in bonds into different buckets. So they group those bonds into different maturities, like from 5 to 7-year-old maturities, so 7 to 10. And then also they look at different credit ratings. They look at whether they are index linked or not, the index often being the consumer price index or the retail price index. Whatever it is, and there's loads of data on these, on different buckets. If you go to Bloomberg terminals, you see the Merrill Lynch or I think Bloomberg bought the Barclays bond data recently. So you get good data on different buckets, different maturities and credit ratings and all that. And that's what we used. You get this price data for these portfolios. You get the yield data, which is computed by inverting this formula. So what you have in the formula, just noticed I have unfortunate clash of notation here. CN has nothing to do with the pension payments. They are the outstanding payments in this bond portfolio or this bond index. And the way they define the YT and the yield to maturity is simply by inverting this equation for Y. That's the yield to maturity by definition. So it's like the discount factor that prices the outstanding bond payments to its current market price. So what we do here, we want to model the price of the bond bucket. That gives them the returns on these investments. What we do is we take the log of this and then take the first or second order Taylor approximation with respect to time, YTM, and the underlying index, if they happen to be index linked. And you get this simple formula, which probably many people know, but for some reason I can't find it explicitly written like this in any book. We published this in Journal of Portfolio Management a couple of years ago. And it fits data really, really nicely. You get some more than 99% R-squared values for many government bonds and index-linked bonds. And it's very convenient to use. You don't need to keep track of the payout structure of this bond portfolio, which may be very complicated. All that is summarized in these 2 parameters, the classical convexity and the duration. So those are essentially enough. They characterize your portfolio. And then you have the simple formula for the log returns, which only depends on those parameters, D and C, and then the YTM. So what you do then is you model the YTM, you come up with a stochastic model for the YTM, and then this formula here gives you the bond returns. And yeah, if you have index-linked bonds, you have this second risk factor, which has this very simple formula. It's just the inflation, the growth rate. So here are some simulations. We came up with those risk factors on the longevity risk, on bond investments, on stocks, and then we stack all those factors together and model that with this first order SDE, or linear time series model. And here are the simulations. We have 3 bonds. So the first one is money market, so very short maturity bond investments. There's government bonds in blue, there's inflation-linked and corporate bonds. Here is the historical data on those, and then there's a single simulation. So it sort of looks roughly as wiggly as the history, so that's a good thing. Here is another picture where we made some 100,000 simulations and then computed the confidence bands for the simulations. Again, you see the historical data and then the simulation. There's the black is the median. This is the money market rate, and this model was developed in 2010, so it's a bit outdated. You see that the money market rate in this model was set to go to 3 in long term, so that's the mean reversion rate in the, essentially it's a Black-Karasinski model for the short rate. Whereas nowadays that is a negative. I think we used the 3-month Euribor rate for the money market returns. And I forgot to emphasize that there are some subjective factors that go in. So for example, the long-term mean reversion rate, we don't estimate that from historical data. That's something that should come from the insurer or the asset managers of the insurance company. That's sort of their expert knowledge that goes into the model. And those have a strong effect on what turns out to be optimal investment strategies, which is kind of obvious if you think of the problem. You invest according to your views of the future. Of course, also depending on your risk preferences, but those are all very subjective, and they should be. So we take those as given, and then we use the historical data to model the uncertainty around these long-term views. So there's the money markets, government bonds, the confidence, there's the median, and then 90% confidence band, and I think 99% confidence band in red. There's the inflation-linked bonds yield, also known as the real yield, and then corporate bonds. Here are the simulations for stocks. We have, I think the blue one is a Finnish stock index, and then the black one is the global stocks. Again, single simulation, and then these confidence bands. Here's a cross-section just to see what the distributions look like. These are now these are historical returns on these 4 categories of bonds. So blue is the money market investments. It seems to be always positive. It's the narrowest distribution, which is what you would expect. And this is what our model gives. We again made some 100,000 simulations, and these are the kernel density estimates of the distributions. So it roughly seems to have the same kind of breadth, the uncertainty, as the historical data. Here are a similar picture for stock investments, history and our model. So again, roughly the same kind of bandwidth there. And then on the liability side, here we have simulated values of the survival index. So the survival index is the percentage of survivors in a population that starts at 1. or you may interpret this as the probability of being alive in the future. And the probabilities here are modeled as stochastic processes. So that's the systematic uncertainty in the longevity risk. So you see that it starts at 1, and then when time goes by, people eventually die, unfortunately. And here's what everything on the liability side comes up to. So this picture shows you the yearly pension payments in billions of euros. So it starts around 8 billion euros a year. Then when time goes by, it goes up when the baby boomers retire, but then eventually they start dying and the yearly claims tend to zero. And in this model, by the way, we assume that we only look at things 100 years, well, we assume that everybody dies by the age 100, just to truncate things. Otherwise, in this model, the theoretical maximum for age is unbounded. So if you're interested in the stochastic modeling of those things, there's several papers that we put out on that. So then back to the optimal investment problem. So we now have modeled the yearly claims, the C's, and the investment returns, the R's. And now we have a well-defined problem. We have a well-defined problem once we specify our risk preferences, which is this convex function V here. In the application that I'm going to show, we use the conditional value at risk. I don't know if it makes sense, maybe not, but it doesn't really matter. You could use whatever, maybe an expected utility. But again, it's a difficult problem. You can't solve it analytically. So what we use is the classical Galerkin method. If you know finite element methods, they are based on the Galerkin method, where you have a minimization problem in an infinite dimensional space of functions, and then you take a finite dimensional subspace spanned by a finite number of functions, and you minimize over that. That's Galerkin method. We do the same here. If you look at this problem, you see that it's convex as soon as your risk preferences are convex, which roughly means risk averse. If you take any finite collection of strategies that satisfy the budget constraint and the portfolio constraints, and they are adapted. If you take any convex combination of that kind of strategies, it will still be feasible. It will still satisfy the budget constraint simply because it's convex constraint, the portfolio constraint. It will still be adapted. And that's what we do. We generate a finite number of feasible strategies by using some rules of thumb, and then we optimize over convex combinations. That results in this finite dimensional optimization problem, which is much, much easier to solve. If the objective function can be expressed in terms of an expectation, then a natural thing to do is to take a quadrature approximation of that. Use Monte Carlo simulation, or Monte Carlo with some variance reduction. And then you have a finite dimensional optimization problem that you can feed into MATLAB and solve with the classic or any of the convex optimization solvers. We used interior point solvers, which are quick for large-scale problems. So the dimension of the problem is the number of these basis strategies whose convex combinations you're optimizing over. In this study, we used some 500 basis strategies, and then that results in about 500 dimensional optimization problem in those weights alpha. Very simple technique, convenient to use. It's still a heuristic. We don't have any systematic way to generate those basis strategies, so you just have to guess them. But the nice thing is that no matter what you guess, the convex combinations will always be at least as good as any of the basis strategies that you start up with. And the nice thing is that in practice, the convex combinations seem to be much better than any of the individual strategies. And that was kind of a surprise to us at the beginning. So in this study, we use 4 types of strategies. We use fixed proportion or fixed mix strategies, which are simply strategies which rebalance at the end of every year to some fixed percentages that you decide at the beginning. If you take another collection of those percentages, that gives you another fixed mix strategy. Already, even if you took all your basic strategies to be these fixed mix strategies with different percentages of rebalancing, convex combinations of them are no longer fixed mix strategies. They can be much, much better than any of the fixed mix strategies. So besides those fixed proportions of fixed mix strategies, we also used buy and hold strategies. You buy bonds, this much bonds, and you just keep them. We also used these target date funds, which are popular in pensions research, where you reduce your risky investments as you approach the maturity of the claims. And then also we used portfolio insurance, which adjusts those weights as a function of the level of your wealth. So anyways, they are all parametric strategies. If you vary the parameters, you get different strategies. And we did that. We generated 529 strategies, and then we optimized over convex combinations of them. Here's what you get. So we had some 500 strategies, and it turned out that only 7 of them got non-positive weight in the convex combination. So that's a nice thing. The results are fairly simple and then easy to implement. And here are the types of the strategies. There are 3 buy and hold strategies, 1 constant proportion strategy, and 3 portfolio insurance strategies. These are the corresponding weights, and here is the optimum value. We minimize the conditional value at risk, and this is what these weights give you. If you look at the values that you would get with any of these individual strategies, you would get these values, much, much higher. The values are in billions of euros. If you run through all the 529 strategies and take the best one out of all of them, you would get that objective value. So 4 times bigger than what we got with this simple convex combination. So that was surprising to us. And it's also interesting to see that this best individual strategy is not even included in the optimal convex combination. You achieve better by taking these, which seem to be worse, but you combine, you diversify across them. So that's how we solve the optimization problem. So it's a heuristic. There's no guarantees how far we are from the true optimum, but it's really simple to implement, and it's easy to interpret. If you want to implement this strategy, it means that you divide your initial wealth in these fractions and then give those money to different portfolio managers who follow these investment strategies. And that will give you this value at the end. There's some papers on that published back in the 2010 and 11. Then if I have time, I would now finally go to the main topic, which is the valuations. So there's some propaganda about the risk-neutral valuations, actuarial valuations, and how they are bad, and how incomplete markets valuations are good. So if you know the incomplete markets theory, there's at least 2 notions of a value, which both have good economic meaning, but they are different. What we are looking at here is this kind of accounting value, which answers the question of how much cash today would you need in order to cover this liability. Another notion of a price would be this indifference price, which answers a completely different question, but also very meaningful. For example, if you have a pension company and a new customer walks in and wants to buy an insurance contract, pension insurance contract, how much would you charge them? Very different question from the accounting valuation question. Both make good sense. But for some reason, I haven't found any reference where these both have been discussed and have been made clear that they are really distinct concepts. We are going to look at the first one, so the accounting value. And like I said, we'll define that using the optimization model that we have been looking at from the beginning. So we'll denote the optimum value of this by phi of c. So c here now acts as a parameter in the problem. It's a stochastic process of the claim payments the insurer is liable to pay. It's a convex function on the space of adapted stochastic payments. And you can define we define the accounting value like this. It's the least amount of initial cash you should subtract from the first component of this process C so as to make the optimum value of the ALM problem good enough. And good enough here is defined to be less than or equal to 0. You could have another constant there, it doesn't change the interpretation. So how much cash should you inject to this insurance company or fund so as to make the fund feasible in the sense that it can find a hedging strategy that achieves good enough level of risk in its final net wealth. So if you look at the definition here, it's a line search problem. This alpha here is the initial wealth, is a scalar, and for each value of scalar, you need to solve the optimization problem to see whether it's enough or not. And that's exactly how we solve this. We try different values of alpha, and every alpha we solve numerically the optimal value, the ALM problem, using the Galerkin method that I just described. If you know the paper by Arsene, Delbon, and Heath, they do exactly the same. They just have a very simple market model over one period and with one asset in the financial markets. Otherwise, it's exactly the same as we are doing. So what we have here is sort of a multi-period extension of the convex risk measure, if you like. You can show that those values lie between these super and sub-hedging costs. So in particular, if you have complete markets, all those things collapse to the same thing. But these pension insurance markets are far from being complete, so they don't collapse. And often the super hedging cost may be plus infinity, so it doesn't make much sense. You can talk about the indifference price, and I'm not going to that now because I don't have time. If you go to the deterministic setting, you can actually compute the accounting value explicitly, and you will get the actuarial so-called best estimate. And here are some results. So, like I said, it's a line search over the alpha, the initial wealth. Each iteration you solve the ALM problem here, and then you see what you get for the optimal value. And after doing that numerically, it takes some time, not like days, but may take a half an hour, depending on your machine. And here are the values. We used the conditional value at risk to describe the risk preferences. We repeated the computations for different confidence levels in the C bar, just to illustrate that the prices indeed do depend on your risk preferences. And here we have the valuations with this Galerkin optimization. Here you have the valuations if instead you just use the best basis strategy in your collection of strategies. So this simple optimization saves you a lot of money. These are billions of euros again. And here's just an illustration of how incomplete the market really is. This is the terminal net wealth after you have paid out all your liabilities. So it's very, very wide. There's lots of uncertainty there. But it's not a problem just with our model. I think it's a problem with the underlying problem. That's the problem the pension industry faces. And I think I'm done.